Let's talk money.
Hello and welcome to a brand new edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. Well, it's been a little over half the year gone now, and it's been a different year, perhaps a difficult year for investors because it's not been a year of straight line equity market returns. So now, as you're assessing your portfolios, what's the prognosis? What's the advice? Not just for the second half of the year, but on a longer term basis. Is this a new normal of sorts that we are in when it comes to markets? Well, today on the show, we are going to get you the Motilal Oswal Private Wealth View. Ashish Shanker is with me on the show to take up a couple of questions that investors really have on their minds. Ashish, thank you so much for joining and welcome to the show.
Yeah, hi Surabhi, always a pleasure to be on your show.
You know, that's where I really want to start because a lot of people got used to very good returns, and returns in quick bursts. But the last couple of minutes, the equity market has been testing our patience. So first of all, you tell us, before we talk markets and portfolios, you tell us what investors are telling you when you talk to them across the length and breadth of the country.
So, I feel it is the much needed temperance that has come in. Because if you look at the last 3 years, it's been outstanding. I mean, till last October, you felt nothing can go wrong with equity markets. Portfolios were doing CAGRs of upwards of 20, and certain mid-cap, small-cap portfolios are doing 25-30%. If you remember, we were hearing about stocks going up in a vertical fashion on the SME exchange.
Yep.
Now you don't hear about the SME exchange. So I think this temperance was much required. I mean, as you know, we released a note at the beginning of the year in our publication called Alpha Strategist. And the title this year in January was Opportunity in Adversity.
Yes.
Right? Or Opportunity in Crisis. Because we felt that this year is not going to be as smooth after 2-3 years of spectacular returns. And it's been a very, very testing year, to say the least, so far.
Yeah, I mean, I'm just looking at the returns as well. I mean, at the index level, the Nifty is up barely 3.5-4% for the year as a whole. And even if you're looking at the mid-cap index, at the index level, we haven't seen gains. Individual stocks could have done, of course, much, much better. But Ashish, do you still get the sense of optimism from investors in terms of deployment? I mean, even if you look at flows that are coming to mutual funds, for instance, the SIP flows are intact, but the overall flows are, almost 40% lower from the peak. So what's the sense you get?
So it's a mood of skepticism right now. I mean, if you look at the indices, they don't tell you the full picture, right? Nifty seems to be up 4-5%. The mid cap is also doing fine. But if you look under the hood, right, there have been a lot of shifts. There have been sectoral shifts. There have been stocks which are down 20-30%. There are some stocks which are testing new highs. So the kind of exuberance we saw in September, October is not there today. So people are being a little skeptical about their allocations, especially when it comes to equities. So I think the mood is that of tempered optimism, which means that if you take the medium and longer term, yes, people are continuing to be positive on India, but they're saying, let me make my allocations in a gradual fashion.
Absolutely.
Because the last 6 months, whenever you've made an allocation into equities, you've got hit by something or the other.
That's true. Right? No, absolutely. And that is where, these are the markets that make you realize the importance of asset allocation and not having all your eggs in one basket, right? And we've seen that. We've seen gold do so well relative to equities over the last 12 months or so. So actually, let's start there. Now let's come to your mid-year call as it stands. Purely in terms of asset allocation, where were you at the start of the year? And have you changed at all between fixed income, equities, precious metals, or anything else?
Right. So, same time last year, if you recollect, we had given even earlier actually, we had given a clear buy call on gold. Although we've always had gold in all our portfolios as a hedge. But we gave a buy call on gold because we believe that the future looks good and optimistic for gold as an asset class. So, it's done extremely well. Now we are saying that you must have gold in the portfolio. But it's probably not an investment call, right? It's more like a hedge back to gold being a good old hedge in the portfolio. So about 10-15% gold, I would say. And I'm right now talking about a balanced portfolio, right? Equities, I would say still we are optimistic. But the outlook from a return point of view, you have to temper down. Let's say 12-15% is a good range to expect in equities in India going forward as well. So maybe 50-55% equities. And the rest, you could do it through hybrid funds, debt kind of an allocation, because hybrid funds give you the tax advantage. Obviously, for portfolios which are much bigger, you have things like structured debt where you can enhance the yields on the portfolio. But this is how I would say you should look at your portfolios. And just to give you an analogy, because we've just had a historic win yesterday, right, over England.
Yes.
Right. So if you actually compare the markets to cricket, this month the title of our report is called Middle Overs, right? So you have the pinch hitting overs at the beginning, right? And then there is a period where, it's a very boring period, but you should not lose your wicket, right? Those are the periods where you keep adding singles. I think in equity markets, we are at that stage, right? Don't do anything adventurous, don't do anything funny, stick to your asset allocation, do your flexi cap, large cap allocation, and just bide your time in the markets.
So take the singles, maybe the big hits are not coming right now. Take the singles, save your wicket. Correct. It's that kind of time in the equity market. That's so nicely put, very well put. Now, within that, let's dive a little deeper, and actually let's start with gold, because you mentioned that, right? And I remember our conversation many years ago where you took a very clear call saying portfolios can even go up to 15-20% on gold. Now, isn't the gold rally looking tired to you? I mean, what's the sense? And people are now moving to silver, so people think, chalo, gold chal chuka hai, let's buy silver. What do you say to that trend?
So gold and silver are not the same asset class, because silver also works on, economic growth. It's an industrial, it's a part industrial, part precious metal. So I'm not too sure about silver, because globally economic growth outlook has been moderated after whatever has happened over the last few months. Gold, we believe, should continue to be there in portfolios as a hedge. So I would say between 10 to 15%, depending on what kind of equity allocation you have. Because remember, gold is a hedge to equity allocation, right? So 10 to 15% is where I would put gold at. But between gold and silver, I would still stick to gold. I mean, silver is a little more complicated than gold. Because for silver to do well, you need global growth, you need industrial growth, because silver is a commodity often used, in industrial applications as well.
Okay, all right. So don't sort of extrapolate the wins and the sparkle of gold entirely onto the silver market. Got that. So let's talk equities now. And you're saying, maybe about 50-55% of the portfolio should be direct, full equity. That sounds fairly low, right? Because historically in India, especially people who have the risk appetite, young or middle, sort of middle-aged, they'd want to have a lot more equity. Is this one of your, lowest historic equity allocations in the model portfolio?
No, not really. I mean, basically, I was giving you color on a balanced portfolio, right?
Sure.
For people who are doing SIPs and building longer-term portfolios, I think you can continue to invest into equities and be a little, be aggressive as well. It's just that, we are saying this is not a time to take a very bold call on equities, right? So, which means overweight is not a stance that I would recommend. I would say that you should be neutral to all asset classes. And like I said, this is a time to bite through markets rather than trying to be very adventurous and trying to create, a lot of alpha in the portfolio. So it's a time to just be careful, that's all.
Fair enough. Now, like I was going back to returns, and the whole question that then next comes for investors is mid-cap, large-cap, small-cap, how to break up that equity allocation. This year, nothing has worked. I mean, the Nifty is up 3.5%. The mid-cap index is flat. The small-cap index for the year as a whole, year to date, is down almost 5%. So it's been tough in that sense. Between the market capitalizations, what's your call, Ashish?
See, it's a classical market for alpha managers, right? Because if you look at Nifty, even in the Nifty, you have stocks which have fallen 30-35%.
Yes.
Right?
Yes.
Take a TCS, which
Tata
is a
Motors,
bellwether
TCS,
stock.
IndusInd Bank.
Right. Who would think TCS will fall 35%, right? And then if you go under the hood, right, below the Nifty, there are stocks which are hitting all-time highs. So what is basically happening is there are shifts happening in the economy. So India is going from, let's say, a low-income country to a middle-income country over the next 3 to 5 years. So consumption patterns are clearly changing, right? A lot of money is going into newer sectors like renewables, manufacturing, and then you have the classic sectors like capital goods and defense coming back because of government capex. Now, unfortunately, a lot of these sectors do not have representation in your main index. So I think this is a period for stock selection. I would say I would be agnostic towards market caps. So a flexi cap fund works well. But in any case, a flexi cap fund will have between 50 to 60% large caps. But within large caps also, right, you have a digital platform which is hitting all-time high. and you have a traditional tech company which is hitting, you know, a 52-week low. So there's that divergence. So I think this is a classical pitch for a alpha manager, right, to pick up the right themes and create alpha in the portfolio.
I have to ask you this, and I know you have the 4 C's framework, I think that's what it's called.
That's right.
Since it's all going to be about the fund manager that you choose to back, right? Give us some names. I mean, so much churn in the industry as well. There are the old stars.
Right.
But in terms of, say, the top 2-3 fund managers that you have your eye on for the next several quarters.
Yeah, so we have more recommendations in the flexi cap category, as you would have guessed from my view. So there are 4 managers that we've put out there. One is somebody who has a small fund but very, very experienced in markets. Both of us know him well, Samir Arora, the Helios Flexi Cap Fund, excellent stock picker. Then, you know, Naren, again, the ICICI Pru Opportunities portfolio, slightly contrarian bent of mind, but, you know, creates alpha through sector rotation. Then we have the Motilal Oswal Large and Mid Cap Fund, which is a high quality, high growth kind of a fund, and the Nippon Flexi Cap Fund, again, a very experienced manager. I think between these 4 funds, you will get a reasonable diversification in terms of style, and all 4 have demonstrated track record in creating alpha. If I go to the mid and small cap names, maybe, you know, an Edelweiss mid cap fund has done extremely well. A Motilal Oswal mid cap.
You know, just hold that thought, because what I want to do is dive a little deeper into these funds and some of the fund managers as well. So we'll take a break and come back with exactly that, some of the key fund recommendations and why Ashish likes both the funds as well as the fund managers. Back with that in just a bit.
Let's talk money.
Welcome back. We're discussing the mid-year outlook and the mid-year perhaps rejig as you're evaluating your investment portfolios. What is it that you should keep in mind? And we're in conversation with Ashish Shanker of Motilal Oswal Private Wealth. Ashish has just told us that it is good to be very well diversified when it comes to your asset allocation, looking at the way markets are shaping up right now. So Ashish, let's now take it step by step. And you've given us a sense that you are going to be market cap agnostic in the equity space. So let's start there. I mean, maybe some funds for what it's worth in the large cap category and someone in the flexi as well, which gives the fund manager the right to move wherever he or she wants to.
Right. So I think the first name that I took was Helios, right? Somebody who's been in markets for close to 3 decades, right? Is an excellent stock picker. Someone who believes that not committing mistakes is a way to create alpha. So I think a seasoned manager like that in this kind of a period will definitely benefit your portfolio, because it's a tricky pitch, right? I mean, you are hit with some news or the other every few weeks. So you need to ensure that your portfolio is positioned in decent quality names. At the same time, you know, you have some earnings tailwind as well going in the portfolio. So that's one name that I would definitely have in my portfolio. Then, of course, somebody who's, again, very experienced, believes in valuations a lot, which is the iPru Opportunities Fund. And it has a track record of creating alpha through sector rotation, right? And this is a perfect market for that.
And it's market cap agnostic.
It's again market cap agnostic. But this is a perfect market for sector rotation. If you look at the last 7 months, at the headline level, like you rightly mentioned, you know, Nifty's not done much, mid cap, small caps have also not done much at the index level. But if you look under the hood, right, there are sectors which have corrected sharply, there are sectors which have come back. And just to name 2 of them, defense has come back very sharply after a deep correction, and you have NBFCs which have corrected sharply. So I think a sector rotation kind of a strategy will work quite well in this period. The third fund that I named was the Motilal Oswal Large and Mid Cap Fund. Now this fund actually blends in perfectly with the first 2 names, and I'll tell you why. Because of the thesis that a lot of the newer sectors are under the index. So if you look at the index, right, it's got the traditional sectors, and just to name 2 of them, banks and IT, where I believe that these sectors are fairly large now in terms of representation, plus earnings growth has been very, very slow.
They may not lead earnings
These
growth.
are tired sectors, and they may not lead the earnings growth. A lot of the newer sectors are below the index, right? Whether it's renewables, digital, etc., etc. And Motilal Oswal as a fund has the track record of picking up high quality, high growth stocks and creating alpha.
Sure.
So actually between these three funds, you get a very, very good selection of sectors and stocks.
Okay.
And your ability to create alpha goes up quite sharply.
So great. Those are three ideas where you can be in a more or less market cap agnostic way. You give the flexibility to the fund manager to pick and choose across large cap, mid cap, and even small cap. But let's move on. For a lot of Indian investors, they love their mid caps, right? So they're wondering at some point mid caps have to start firing up, mid and small caps. Right. Over here, which are the funds and the fund managers that you're liking now?
So in the mid-cap space, I think Edelweiss is one fund which has been very consistent in the mid-cap space. They've demonstrated consistency. They demonstrated the ability to pick stocks. I mean, they are basically running as per the GARP philosophy, growth at reasonable price. The quality selection is very strong. And then they also look at the valuation criteria. So that's one fund. The second fund, I would say, has been like the top performer over the last few years, which is again the Motilal Oswal Mid Cap Fund. They have demonstrated their ability to go through cycles in spite of a concentrated portfolio. Generally, you would find that the mid cap portfolios are very, very diversified.
Yes.
But this is a fund which holds 25 to 30 stocks and has managed to create alpha. So between the two, you get a reasonable diversification in the mid-cap space. In the small-cap space, we have two recommendations. One is the Invesco small cap. Again, an experienced manager. Because in the small-cap space, what is very important is you don't want mortality. So as you
companies dying out, basically.
Yes. As you go down the cap curve, quality becomes extremely important.
Yeah.
Right. So I think Tahir is somebody who brings in that experience and attention of quality to the portfolio. So I think Invesco small cap has a good track record, and then you have the Bandhan small cap, again experienced CIO at the helm, which is Manish Gunwani. So these are some of the recommendations
on the equity
side.
Got that. So that's pretty helpful for those who are looking to add more money and looking at enhancing their equity portfolios. You have plenty of options to choose over there. Now, Ashish, hybrid funds. And, we've been seeing that. I track the data on a monthly basis as well. Last couple of months, very steadily, hybrid funds are now pulling in as much money as, pure equity funds. So clearly, investors are understanding the benefits of diversification. But how do you choose a hybrid fund? It's a very vast category, a lot of different types of funds, aggressive hybrid, balanced advantage, etc. So where do you start?
Right. See, generally, the hybrid funds are a stepping stone to mutual funds, right? People who are traditionally bank deposit investors, or people who've just opened a demat account and now want to start investing through mutual funds, they come through the hybrid category, and advisors also often recommend that as the first stepping stone towards building a mutual fund portfolio, right? So in that category, typically people go with tried and tested. Okay, so one of the funds which is the largest fund and still doing extremely well is your iPro Balanced Advantage Fund, right? Which is more aggressive towards equity, but they balance the portfolio also pretty regularly. Then the second one is HDFC. HDFC is more aggressive than ICICI. So these are stepping stones towards getting closer to equity allocation. Then you have the multi-asset category as well, right? Within the multi-asset category, one of the smaller funds that we've recommended is Vitok, right? Which is true to label multi-asset. It's got gold, it's got equities, it's got debt. And even the debt portion, what they've done is partly, they've done it through the arbitrage strategy. So you get a taxation which is better. After 2 years, it's long-term capital gains. So these are few of the hybrid categories that we like. And then if you wish to be even more conservative, then you have the equity savings category, where the equity portion further goes down.
It's more like debt-like returns.
It's more like debt-like returns. The risk is debt-like, the returns are debt plus. So that's also a good category. So
and any specific AMCs you like here?
So again, I think there, you go with the bigger ones like an ICICI or an HDFC, because they have track record in that category. So these are, and these funds actually come very handy in these kind of markets where the volatility is extremely high and you don't want to stomach that kind of volatility. For somebody who's not experienced and starting off investing, so on and so forth.
Speaking of debt-like returns, I wonder what your view is on REITs. It's a new asset class and again promises to be fairly steady, but more tax efficient than even debt funds, which lost the pure debt funds, which lost that tax advantage. Is this an asset class you're liking?
Yes, for portfolios which are larger in size and people who can access, the exchange, REITs definitely make a lot of sense. The only thing to take care of in REIT is the volatility in the near term can be much higher than, let's say, a conservative debt fund like a equity savings fund, because the asset, the prices move almost like equity, right? So you have to take a 5-year call. Over a 5-year period, you'll be fine because you get the rental income on a regular basis. Plus, the asset value also stabilizes over time. But in the near term, based on supply demand, right, the prices can vary quite a bit.
If you look at the REITs price on a daily basis, trading on the
can be very
exchange,
volatile.
then it could be.
It trades almost like equities, albeit less volatile than equities. So if you do not have the stomach for that, then REIT would not be the first category that I would recommend. Probably you come into equity savings or balanced advantage funds, and then the next step could be having a REIT portfolio. And if you take a 3 to 5 year view, you'll be fine. I mean, you'll get returns higher than equity, and you'll also get the tax advantage.
Understood. So this is really helpful, and now we have ideas to choose from across all the different asset classes. So let's recap then. What is the final advice, and what would you say would be perhaps one or two of the big mistakes that we as investors need to avoid as we navigate these rather confusing markets?
Right. So every time we say the markets are different, but they teach the same lessons. So if you look at last year, right, everybody was super bullish on small cap, mid cap, and a lot of people started investing in SME. Many people started going to IPOs, right? So ultimately, when it comes down to equities, it's about buying good funds, good stocks, staying for a longer period of time, having that patience going through volatility. So I think one big mistake that people probably would have committed, and now they are wiser, is going down too much on the cap curve, right? And buying these stocks directly, because a lot of these stocks don't have coverage, you don't have hand holding. So that's one mistake. Second is, going overboard on any asset class, right? So when equities were doing extremely well, people tend to load up on equities. They tend to go overboard. And then in markets like these, right, then you get a, rude shock on how your portfolio is performing vis-a-vis expectations. So I think, ensuring that you don't go down too much on the cap curve, take too much risk in frothy markets. Second is, sticking to your asset allocation. And in these markets, right, currently the markets we are in, I think the best thing to do is stick to the basics.
Keep it simple.
Yeah, things are tough. They will continue to be tough, because I don't think this entire, challenge of what's happening globally on tariffs, etc., is over as yet. So we will see more of it.
Hunker down, stick to the basics, follow your asset allocation, and don't take on too much risk. So it's great advice. Thank you very much for putting it out so simply and beautifully for us, with some ideas, of course, of where we can be investing. Many thanks, Ashish. Great session as always. Thank you for joining us today.
Thanks, Surabhi.
All right. Well, with that, we're out of time on this edition of Let's Talk Money. Keep sending us your feedback, comments, and queries. We will see you again next week.
Let's Talk Money